Something interesting is happening in real estate right now. While headlines keep warning about high interest rates, market uncertainty, and economic slowdowns, smart investors are doing the opposite of what the crowd expects. They're not panicking. They're not waiting. They're quietly buying property. Not loudly, not publicly, but strategically. And the reason they're doing it in 2026 may surprise you. Smart money moves before headlines change. Smart investors don't wait for good news. By the time the media says the market is safe, the best opportunities are already gone. In 2026, real estate is sitting in a rare window. Prices have softened in many areas. Competition is lower, and fear is keeping average buyers on the sidelines. This is exactly when experienced investors step in, because they understand that wealth is built during uncertainty, not comfort. High interest rates are scaring the wrong people. Most people see high interest rates as a deal breaker. Smart investors see them as a filter. Higher rates push casual buyers out of the market, reducing bidding wars and emotional pricing. Investors focus on the property's fundamentals: cash flow, location, and long-term demand. They also know rates change, but the asset stays. A refinance later can fix a rate. Missing the right property can't be fixed. Rental demand has quietly exploded. Home ownership is becoming harder for average families. Rising living costs, stricter lending rules, and delayed life milestones have pushed more people into renting, and for longer periods. In 2026, rental demand isn't a theory, it's a reality. Smart investors follow demand. They're buying properties that generate steady monthly income, knowing that strong rental markets protect them even when prices move slowly. Inflation still rewards real assets. Cash loses value quietly. Real estate doesn't. Smart investors understand that property is one of the few assets that historically keeps pace with inflation. Rents rise, replacement costs increase, and land remains limited. Even when markets cool temporarily, real estate holds real-world utility. In 2026, owning assets that produce income and adjust with inflation is a strategic move, not a risky one. Forced appreciation beats market timing. The smartest investors don't rely on market appreciation. They create it. In 2026, value-add strategies are thriving. Renovations, better management, short-term to long-term rental conversions, and improved tenant quality. These investors buy underperforming properties and improve them, increasing income regardless of market cycles. This approach gives them control, not hope. Institutions are buying too quietly. Here's what most people don't notice. Large funds, private equity firms, and long-term investors never stopped buying real estate. They adjusted strategies, not conviction. They're focused on logistics hubs, rental housing, and cash flow assets. Smart individual investors often follow the same logic on a smaller scale. When institutions accumulate quietly, it's usually a long-term signal. Real wealth is built over cycles, not years. Smart investors think in decades, not months. They know that real estate rewards patience. Buying in 2026 isn't about flipping fast. It's about positioning. When markets recover, rents grow, and rates normalize, today's risky purchases often become tomorrow's best decisions. History shows this pattern again and again. Smart investors aren't buying real estate in 2026 because they're reckless. They're buying because they understand cycles, demand, and long-term value. While others wait for certainty, they quietly secure assets, lock in income, and prepare for the next expansion. Real estate isn't about timing the market, it's about time in the market.